Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I get a question very, very often, what are the size of those contracts? The size is quite simply that pair value multiplied by 100, so it's floating. So if we go back to the euro, that contract is worth about $12,565 today. Now in March it was actually worth $13,700, so it's a floating contract. So the notional values will actually change based on the exchange rates. And you see that there also, whether it's dollar base or dollar quote. So here's a nice simple table of the ISE family of currencies. You can trade them per US, in US, and it's right there. So it's very, very simple. And if you're interested, you can always come back to this archive just to refresh your memory. You can go to FX options where we have the same sort of table there in many different places. It's very important to know if you're looking at the base, you're bullish on the base, you might be looking at buying calls or call spreads. In the case of the dollar, they're now, if you're looking at the euro against the dollar and you're bearish on the euro, you would be buying puts. It makes sense. If you're bearish on the euro and the EUI, you'd be buying calls. So that you got to make sure that you are trading the right instrument for your market forecast. So the features of these ISE FX options were their options on exchange rates, 50-cent strike prices, the premium is quoted in the US dollars. European exercise, cash settled, noon settlement. The trading hours are now, actually, I'm going to the bottom, trading hours are 7:30. We just started that on April 30th. We have market makers. We have a couple market makers that are quoting these, providing liquidity, so that's a good thing for all of us. And they're available in your conventional brokerage account. They settle at the WM Reuters rate, and the settlement is on expiration at noon Eastern Time. So here's an example of cash settlement. If I look at a settlement of 96, and I'm looking at the 100 put, well, my value would be 4, the 98 put. Remember, if I have the 100 call and we fall down to 96 or 98, the calls are worthless. However, the calls gain value as the exchange rate moves up. So if I go to, let's say, 106, well, then, and only then, will that 100 call be worth 6 if the pair value, this is at expiration, closes at 106. So what are the strategies that are available? Well, tons of different strategies. You could buy calls or call spreads. Puts or put spreads. You can sell calls. You got to remember that you need to consider your margin there. You can sell puts. Again, you got to think about your margin. And then you could even do the more advanced option strategies such as diagonals, calendars, straddles, strangles, condors, butterflies. The one strategy that you can implement, though, is the covered call, and you can always hedge also. So the notional contract is going to be 100 times that pair value. So for example, trading around 100, let's say if it's exactly 100.32, well, on that day, the pair value or that contract is worth about $10,032. When I say about, it's actually worth that, but it's going to keep changing, if it goes up or down. So, hedging, you might want to actually rebalance your portfolio if you needed to have a very precise hedge. Hedging using calls, if you're hedging potential dollar strength, well, the dollar is the base currency, you need to buy calls. The dollar is the quote, you need to buy puts. If you're hedging potential dollar weakness, well, the dollar is the base currency, you need to buy puts. If the dollar is the quote, you need to buy calls. So which strike price would you trade? Well, that's up to you, of course. There's no, and I see this sometimes in books where they say, if it's trading at 100, you should consider buying the 98 call and the 96 because the delta is this or that. I traded on the floors of 3 different exchanges for a couple of decades. I'm not a big believer that there's one magical strike price to trade. It's about risk reward. So you need to understand a little bit about the delta, which means how much will the option move. The underlying moves, and you'll notice that 96 call has a pretty high delta in this case. But if you want to see a high delta in puts, you can look at the 106 puts. It has a pretty high delta also. So you could buy the out-of-the-money option. The one, let's say the 96 put only has a 14 delta. The 106 call has an 11 delta. Those are more levered positions. Doesn't make them good or bad. It just actually makes them a bit more risky because with leverage comes risk and reward. So you need to think of it in those terms. So hedging dollar weakness. Well, let's say if you had a hypothetical $100,000 portfolio, and you wanted to think about how many contracts you need. Well, it's 100,000. That's your portfolio size divided by the contract size. So you need about 10 contracts. So which strike price, that would be up to you. Whether it's the at-the-monies, which again is going to give you, if you'll notice here, I did some calculations on the cost of 10 contracts. Obviously, the deeper in the money, then you basically would look at how big of a hedge. If you notice that when I say that the 106 you might need 11 contracts, well, that's because you don't have 100 delta. You might have 90 delta, so you might need one extra contract. But again, you don't have to have that 100 delta or delta. You don't have to have complete hedging. But that's up to each investor. And you'll notice that the 96, you would need 71 deltas. 71 contracts to hedge that. So that might have been a really nice trade last week when you get big moves. When you get small moves, you're probably going to want the at-the-monies or even the in-the-money options. Out-of-the-money options work really well in volatile markets. They do not work well in quiet markets. So there's no right answer to which contract is best. I like to teach, when I'm teaching basic options, that you start with the at-the-money. So if I was looking to hedge, I might say, okay, I might buy the 100 strike. Now, another consideration is, do I do it delta neutral or not? I don't know. We know that if you buy 10, the first couple points down, since you have a 50 delta, you're still going to have some risk. If you bought 22, well, then you basically now be in a position where if it started dropping very, very quickly, you'd actually be even overhedged, and you could actually sell out of some of your puts at a profit. But again, if nothing happens, you could lose a considerable amount of money. Hedging U.S. dollar strength using dollar Canadian, well, we look at it the same way. In the money options, you might need as little as 11. Out of the money options, you might need as many as 91, with the delta being so low. And that delta is based on an assumption of volatility. At the time when I put this presentation together, the deltas change based on volatility. So just be aware of that. So again, where would I start? I would probably start with the 100 and then maybe move to the 98, 102, and there's no right answer, whether it could be the 96, could be 104 or 106. This is where I like to say it's a little bit of an art, not completely science. So you might say, okay, here's the delta, but you don't have to trade them delta neutral. You can, you don't have to though.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.